Welcome back to Happy Investors. We share Nvidia insights for inspiration for those without our advanced tools. Note that this is purely quantitative, meaning data-driven, and not fundamental, which focuses on quality and intrinsic values. I will show various sources that you probably do not have access to, so enjoy the show, but draw your own conclusions. And remember, we are primarily long-term investors. Don't forget to visit our website and download the free stock book, free ETF book, and more free downloads. You can find that on our website. The links are in our YouTube description. And we also have advanced analyses for those who want it for just €99 per year for growth, value, and dividend stocks with the potential for the best winners, and we achieve demonstrably higher returns. We do not have a position in Nvidia. I have had one in the past, but not at this moment. Still, Nvidia scores very high on certain data-driven sources. But first, what is the long-term potential? It depends on which angle you look at it from. As is known, Nvidia has a strong economic moat, great company, great leadership, that kind of thing. The fair value asset from Morningstar is $150. Therefore, it gets 2 stars because the current price is almost $150. This means that Nvidia could be overvalued. In the very short term, analysts, and there are quite a few, give a price target of around 150, which is almost in line with the current price. But the Nvidia rating is high in the short term. In the long term, it is really a question of whether they can actually provide a good return. The stock has, of course, now passed 3 trillion. Looking at historical valuation, it has risen enormously in a very short period, of course, due to that AI hype. However, if you look at a scale of 7 years, for example, we see that the fundamentals have deviated significantly from what a normal PE ratio could be for this great growth company. So the PE ratio is now following the normal multiple. However, if we look at a forecast based on price, it correlates with adjusted operating earnings. And if you look at what a normal PE ratio is for this type of company, you arrive at 30 given the significantly higher growth. The current price to earnings is around 60. If you then have a PE of 30, combined with the future EPS growth estimate for 2027, it means the upside potential is not very large. However, this is of course based on the price earnings of 30. If it is based on, for example, 40, then you still have a return. If it is lower, let's say 25, then you have a negative return. These are of course all pure estimates, so use them purely for inspiration. Also, if you look at the long-term, analysts estimate that the long-term growth can be 30 to 32% EPS growth per year. And where do you end up with the current valuation? You arrive at an annual potential return of 6.7%, but you need to be very sharp here and think logically, because Nvidia is a company worth more than 3 trillion. Gigantic. Everything suggests that the company is doing well now, so no account has been taken of downside potential. There is a significant downside potential if things go wrong. For example, if the economy declines or if the AI solutions turn out to be disappointing and investments in AI decrease significantly. So what it comes down to is that the current valuation is actually relatively high, relatively speaking, but it also seems that the valuation may be high for the company at this moment for long-term growth. Consider a company worth 3.5 trillion or more. If it needs to grow 30% annually, in 10 years you have a company that is enormous, the largest company in the world, in terms of market value. The question is whether all of that is realistic and whether it is mathematically possible. So think carefully about what you are getting into. The failure rate, based on quantitative sources, receives a score of B. In other words, relatively speaking, compared to the sector median, it is actually still on the lower side for Nvidia. A 1.5 would normally not be high, but pay attention. The failure rate takes into account 3 to 5 years of future EPS growth, and if that disappoints, the failure rate is no longer the truth. You see, other valuations are very high, price to earnings and price to cash flow above 50. I think every value investor might have some trouble with this. But yes, if Nvidia's growth continues, then it is indeed a value stock. So that is the crucial question. Is the market right here? Yes or no? Or is it a real hype? Often, a Hype leads to very high valuations and there is no risk to take into account the risk, in other words, downward potential. And the growth estimates for Nvidia look very high. For example, free cash flow is set for a growth of 180%. We have Buffett. Of course, he likes to invest based on free cash flow, and if that grows by 180%, yes. But everything depends on the valuation in the long term. So, intrinsic value must be calculated by yourself and is not included in this short analysis. Also look at Nvidia's profitability grade, which is extreme. What a great company. A gross profit margin of over 70%, net income margin of over 50%, gigantically good. Return on equity is currently very high. And yes, everything is visible. AI is booming. And in the short term, ZexRank gives a buy based on EPS estimates. Their price target for the next 6 to 12 months is really just 151, in line with other analysts. Well, the current price is 149/146. So, there doesn't seem to be much upside potential left for Nvidia. Maybe there is, but it's very difficult to exceed expectations when they are already sky high. More realistic and plausible is that it can just as quickly go wrong, and Nvidia is, of course, active in the entire semiconductor sector. Don't forget, that is a cyclical sector, and you often see these cyclical movements recurring. Just in 2021, when all growth stocks fell hard, Nvidia was no different, having dropped by minus 63%. Unfortunately, I sold my Nvidia shares a while ago, but I was still active in 2018. You can hardly see that here on this scale, that the price has risen so much. But in 2018, the price was around 6.5, and it then dropped to just around 3. So also a decrease of minus 50%, and this has happened before. So simply put, suppose you are patient and you are lucky, and Nvidia drops by 50%, which could absolutely be realistic in this scenario. Buy a company at half price. It depends if that happens. The question, is the market right?